Welcome to Chapter 11 of Intermediate Accounting. In this chapter, we're going to continue to talk about property, plant, and equipment and intangible assets, but we're going to focus on the utilization and the disposal of those assets. So let's jump right in. First, let's look at allocating the cost. So we have different allocation methods. For property, plant, and equipment, we depreciate those assets. So you've seen that even in financial accounting, and we're going to talk about depreciation methods in this video. But then we have depletion of natural resources. Same idea, but treated just a little bit different. So we're going to look at that in a later video. And then we have amortization of intangible assets, which is treated basically like straight line depreciation. So we're going to cover all of that throughout the next few videos for Chapter 11. So you aren't going to believe this. What? It's time for a new case study. So every chapter we have a different case study, a different company that we are working with. So what is it going to be for Chapter 11, which is the final chapter in Intermediate Accounting 1? Drum roll. It is Dirt Rich Industries. Dig deep, spin smart. So let's dig in. Dirt Rich Industries purchases a heavy-duty flatbed truck for $58,000 to transport excavation equipment between job sites. The company estimates that at the end of the truck's 5-year useful life, it will have a salvage value of $10,000. So the salvage value, which is also called residual value, that is going to be what we expect the truck to be worth at the end. So they're not going to use the truck until it's complete trash and they just push it off a cliff. Kidding. But they're not going to use it until that point. They're planning on selling it when they're done, and I think they'll probably get about $10,000 out of it. Now, it's just an estimate that it's going to last for 5 years, and it's just an estimate that it's going to be worth $10,000 at the end. But we're going to take that $58,000 and we know that at the end we're expecting it to be worth $10,000, and over those 5 years we are going to be using up our estimate of $48,000. So let's look at our cost allocation considerations. So first we have to think about that service life. So the projected amount of service that the asset will provide. So how long or what kind of service is it going to provide? We just saw 5 years with that truck. Then we have the allocation base. That is the amount of the asset's cost allocated to operations during its service life. So for the truck, it would have been $48,000. Then the allocation method, the method by which the asset's cost is systematically allocated over time. So we're going to see different allocation methods. So let's jump into these a little bit more. So for the service life, the anticipated benefit that the company expects to gain from the asset. So for how long or for how much activity, so either time or activity, are we going to deem the service life that's estimated out of this asset? So with Dirt Rich Industries, they purchased the portable rock crusher for use at its various mining sites. The company estimates that the crusher will be used for 5 years or for processing approximately 150,000 tons of material, whichever comes first. This means the estimated service life of the equipment can be measured either in terms of time or usage. So either those 5 years or those 150,000 tons, depending on how the company expects to use that asset. So an asset's physical life depends on its intended use and the conditions in which it operates. The service life may be shorter than the physical life. So we may say, okay, like that first truck that we saw, it has going to have a salvage value of $10,000. So its physical life is going to be longer than 5 years at an estimation, but we're only expecting to use it for 5 years. Clearly, there's still some life left in it. That's why we think we can still sell it for $10,000 when we're done. So that's going to be determined by the company. But why? So here's some possible reasons. Technological advancements. So it could be that whatever asset we have, we know that technology is changing and there's going to be something more up to date later. With computers, Sure, you can probably get 8 years out of your computer, but we know that after 3 to 5 years, it's not going to be working the same and there's going to be new technology out there. So we usually depreciate computers over 3 to 5 years. Could be management's intent with the asset. Sure, it's going to last for 10 years, but we think we'll only use it for 8 years. Efficiency and obsolescence. So with the truck, it could say, okay, look, we're going to get 5 years out of it. Somebody else may want to use this for longer, but for our use, we want to make sure it's being efficient. And we know that after 5 years, that's probably going to be the most we can get out of it. So what about intangibles? We have lots of little helpers today. The contract life will not provide value for the entire legal life of the asset. That's when you're going to see the service life be shorter than the physical life. So we looked at this some in the last chapter when we talked about patents. So a patent lasts for 20 years. So you would typically amortize a patent over 20 years. But if you determine that the service life is not going to be as long, it's not going to bring us value for a full 20 years, then we would amortize it over a shorter period of time. All right, then we have the allocation base. So the portion of the asset's cost that will be used up over its useful life. So we have the cost of the asset minus the residual or salvage value. Residual and salvage mean the same thing here in accounting. That means what we expect it to be used for, or what we expect it to be worth at the end when we're done using it. So that tells us how much we need to depreciate over the asset's service life. So for that truck we saw in the first example, we said that we paid $58,000 for it. We expect it to still have value of $10,000 at the end. So the $48,000 would be our allocation base. That's how much we need to expense out over time. All right. Then we have to choose our allocation method. That's what the rest of our video is going to be on, is looking at the different depreciation methods that we cover in this chapter. This is the expected manner in which the asset's value will be used up. So how long is it going to provide us benefit? So we can do this over a few different ways. US GAAP says the chosen method should allocate the asset's cost as equitably as possible to the periods during the services during which the services are obtained from use. So GAAP tells us we need to do this in the most systematic and rational way possible. So we'll look at the different ways and then we'll talk about how we typically see companies depreciate their assets. So the allocation methods, we can do time-based. So that's going to be a cost over the asset's useful life on a time-based schedule, monthly or yearly. And it could be activity-based, so calculates depreciation based on the asset's usage or production. So we're going to look at 3 methods that fall under time-based, and then we're going to look at 1 method that falls under activity-based method. So the time-based is going to be straight line depreciation, which is the easiest. It's very straightforward. So we're going to focus on that one first. It spreads the asset's cost evenly over the useful life. It is the most common and the easiest one to apply, and it's based on the passage of time. How long do we think the service life is going to be? Then we have a variety of accelerated methods. We are going to cover 2 of those accelerated methods in this chapter, but there are others. So when we say accelerated, it means, okay, straight line, you're just going to be taking the same depreciation every year for the service life of the asset. But with accelerated, they're going to try to take it faster in the beginning and then slow it down over time. So you're going to see that where we expense out more right in the beginning, that's accelerating the depreciation. And then as it gets further into its life, we're not depreciating as much. The activity-based, the one we're going to focus on, is units of production, which is going to be about what we'll see with depletion when it comes to our natural resources. This is not based on the usage of time, it's based on the usage of the actual asset. So it's tied to some kind of measurable activities, hours that it's used, units it's made, miles that we've driven it. So really great method for certain assets, but it can't be used for all assets. So first, let's jump into the straight line method. Dirt Rich Industries purchases a drilling rig for $120,000 to use at its excavation sites. Other pertinent information. estimated useful life of 6 years, salvage value of $12,000, estimated output over its life of 240,000 tons of materials processed. This is the actual output over those 6 years. We'll see that come back up in the units of production, but first we're going to look at the 120,000 that the asset cost, and we're going to consider the salvage value and the 6 years of time. So we have the straight line depreciation. We're going to take the cost of the asset minus the residual value divided by the time that we're expected the service life to be. So the 120,000 we spent on the asset minus the 12,000 of residual or salvage value. Then we divide that by the 6 years. We're going to depreciate 18,000 each year. Now, let me just make a little caveat here. So most companies will not depreciate at December 31st. They're going to divide it by 12 and they're going to depreciate a little each month. So that's what you're typically going to see. Usually in these textbooks that we use, we see that they do it annually just to make it simpler as we're learning these methods. But just know in the real world, they'll probably take that 18,000 and divide it by 12, and then they'll expense it out monthly, which makes it more even over the 12-month period so that it's not all one big hit in December. So just be aware of that situation. Okay, so we've got 18,000, and we're just going to go ahead and do all the depreciation in 1 year. So this is one way to look at it as well. So we had the 120,000 minus 12,000, which gives us 108,000. So we're going to see these charts for all 4 of the methods we're going to go through. So even though it's really simple, we don't really need it for straight line, it's good to just look at it here and see what these charts are used for. So the depreciable base for straight line is the 120 minus the 12,000. So we get 108,000. We multiply that times 1 out of 6 years, right? So we're dividing it by 6. Same thing we saw on the last slide. That gives us 18,000 each and every year that we depreciate. So we always debit depreciation expense, credit accumulated depreciation. Accumulated depreciation is a contra asset. So it is going to show up on the balance sheet under the assets, directly under the asset that it correlates with. So for this one, it would be that drilling rig. It would probably say equipment, and it would say 120,000. Then right below it, it would say accumulated depreciation, and for the first year, it would say 18,000. Accumulated, so it keeps building on itself. So it's not a temporary account. Depreciation expense, of course, is a temporary account found in the income statement, but accumulated depreciation stays on the balance sheet the entire life of the asset. So remember what the book value is. Knowing how to calculate a book value is very important, and it's very, very simple. So the book value is just going to be the cost of the asset minus accumulated depreciation up until that point. So 120,000 minus the 18,000 for the first year gives us a book value of 102,000. Then we go into the second year. It's straight line, so we do the exact same thing. And now accumulated depreciation, after making the same entry again, accumulated depreciation will be 18,000 twice because we've done it for 2 years. So now it's a total of 36,000. Our book value is 120,000 minus accumulated depreciation of 36,000, which leaves us with 84,000. So each year for the 6 years, we record 1/6 of that depreciable base, 1/6 of the 108,000. And then when we get done at the end of year 6, there's a book value of 12,000. Why? Because that is the salvage value. That's what we expect it to still be worth at the end. So 120,000 minus the 108,000 we depreciated leaves us with a book value of 12,000. And that's what we expect at the end of its life to be able to sell it for. So then we'll see in the next video, when we do actually sell it, how it compares to the book value and what we do with that. But let's jump into the double declining balance method. So we have the same company, the 120,000, the 12,000 in salvage value, but with double declining, we are going to see basically straight line. We are going to take that number, the 1 out of 6 years for straight line, which would basically be 16.67%, times 2. We're going to double that percentage, and that brings us to about 33%. So what you do for double declining, much more complicated than straight line, so stick with me here. So for double declining, we take the whole 120,000, the whole book value, and we multiply it times that percentage that we just came up with. Again, it is basically the straight line percentage, 1 out of 6 years, gives us 17% almost, times 2, because it's double declining, we're accelerating it, gave us 33%. So we take the 120, this is the book value, times the 33%, and that gives us our depreciation expense. So for the first year, depreciation expense is, I apologize, I thought I had the journal entry there. The first year depreciation expense is a debit of $39,600, and accumulated depreciation will now be $39,600 of a credit. So our new book value, we have a $120,000 cost minus accumulated depreciation, gives us a new book value of $80,400. Notice the new book value is carried to year 2, and that's what we multiply times the 33%. So it gives us less in depreciation expense the second year. We add the second year's depreciation expense to accumulated depreciation. That gives us a total of $66,132 sitting there in that credit contra asset account. So now our book value is 120 minus the 66,132. So our new book value is 53,868. We bring that to the year 3 depreciable amount. We multiply that times the same percentage. So we've got the same percentage every time. We're just multiplying it times the new book value, which keeps getting lower. So see, it was accelerated. We depreciate a much higher amount, and then it gets smaller and smaller as we go. So we do that each time. We take the new book value, multiply it times 33%. Now let me point out what we're doing on year 6. So we finished year 5 with a book value of $16,200. We had a $120,000 cost to the asset minus year 5's total accumulated depreciation of $103,800. That leaves us with a book value of $16,200. Well, see, in this one, we were not taking the salvage value into account when we started, but we want to make sure we still end with the salvage value. We want to make sure we still only depreciate the $108,000 that was our total depreciable amount. So instead of multiplying the $16,200 by 33%, we just fill in the rest. We say, okay, we need there to be $12,000 left. Right now our book value is $16,200, so we just subtract $12,000 from that, and it tells us that we need to depreciate year 6 by $4,200. That brings us to a total of $108,000. And it leaves us with a book value of $12,000. So you have to make some adjustments on the double declining balance method whenever you get to the end there in order to force the salvage value amount. All right. So another accelerated method. This one is really interesting. Okay, so sum of years digits. So stick with me on this one, okay? So we're going to use the chart again. Notice we are using the same depreciable base for the whole time. We're going to use the full 120,000. But we do something a little odd with sum of years digits. We actually take the sum of the years digits. Here's the formula for it. N being the number of years that we expect to use it for, 6 years, times 6 plus 1. Then we divide it by 2. That gives us 21 in this case. Basically, what this formula is doing for us is it's taking our 6 years, and it says 1 plus 2 plus 3 plus 4 plus 5 plus 6, and that gives us 21. So the formula is doing that for us. Super odd, right? I mean, we're just taking the total of the years added together, the sum of the year's digits, and we're using that as our denominator for our depreciation rate. And then you see here in this column, depreciation rate per year, we're taking for the first year 6 out of 21, that amount we came up with here. And that's what we're doing. We're taking the whole 120 times 6 divided by 21 gives us our depreciation expense. Then we keep that full 120. This time we multiply it times, there's only 5 years left now, 5 out of 21. And we do that each year until it gets to the end. But again, we have to force the salvage value. So we're going to force that by saying, okay, at the end here, we actually got down to 17,143. And this was, if we multiplied 120,000 times 2 out of 21 years, that was actually going to come up with more than what we needed, and it would have dropped us down below the 12,000. So we had to force that amount, and we actually didn't depreciate anything in year 6. And this is all going to depend on how much the residual value is. If they said, no, our residual value is $5,000, then okay, we would have had to do more. But since that was a pretty high residual value, we ended up finishing our depreciation for this under this method in year 5. Now, our final method, which is an activity-based method, is the units of production method. So in this one, we are now going to consider that they told us that they were approximating that they would be able to excavate 240,000 tons of material. And if you remember on that first slide where I introduced this whole problem, it told us how many units were produced each year for 6 years. So that's what I pulled in over here just from that first slide. So this is how many units were actually produced. Now, this is not a real world situation because they estimated there'd be 240,000 tons, and there was exactly 240,000 tons. In the real world, the estimate wouldn't be perfect, but like we would again get it to where at the end, if we had to force it, we would make sure it was 12,000 at the end either way. So the way we come up with how much we're going to depreciate it by each and every year is we have to get a depreciation rate. So in this one, we're going to kind of start out like we did with straight line. Really, we take the amount we paid for it, the 120, minus the salvage value of 12,000. Then we divide it, instead of by the number of years, we divide it by the number of tons or whatever the activity is. So that gave us 45 cents per unit. And since we're taking the salvage value into consideration, if the estimate's perfect, like it is a lot of times in a textbook, then it'll end up perfect at the end and we'll still have that residual value amount. So that 45 cents is per unit or per ton that we're going to be depreciating it by. So in the first year, they processed 30,000 units. And we multiply it times that 45 cents we just calculated, and that tells us our depreciation expense. And then that's all we have to do. Each year we take the number of units that are produced times the 45 cents, and that gives us our depreciation expense. And we can just watch the book value decrease over time until it gets to the 12,000. So it's really the same idea as we saw in the other methods as we watch the book value decrease. But in this one, it works out really well because as the units are produced, we see the amount of depreciation match up with that. I really like this method if it is something that we can really identify something like this. A vehicle is another really great way to use units of production because you might say if Amazon buys a new truck, they might use it for way more miles the first year than they do the last year. And instead of it being straight line over time, they say, no, let's do it based on how many miles we drive. Maybe they expect to drive it for 200,000 miles. So let's use that as our denominator when we come up with our depreciation rate per unit or per mile. So this is a good way to do it based on that. It is a lot to keep up with though. So, a lot of times companies are looking for ways that it can be a little simpler and not be so difficult and so much extra record keeping. So let's compare these 4 different methods. So all four of these methods ended up depreciating the same amount over those 6 years. So, obviously the straight line, we calculated it just like this, the units of production, where we took out the 12,000 and said we want it to have a book value of 12,000 at the end. Then with the two accelerated methods there in the middle, we kind of forced it to equal 108,000 of depreciation and have the 12,000 that was still in the book value. But regardless of which way you do it, it still ends up being the full amount that you want to depreciate, and it's the same either way. But you can see from years 1 to 6 how much we depreciated it over each year. So which method do you like best? If you were a company that's trying to choose which method to use, which one would you choose? And what would you base that on? So let's look at what other companies do in the real world. Here we go. So straight line depreciation dominates financial reporting usage. Multiple studies report that straight line is being used by roughly 95 to 98% of major companies, and that's from a study done on Google Groups. 95 to 98% are using straight line, and why is that? Because it is the simplest way, as you saw, very simple. We don't have to do any extra record keeping. It's predictable. We know how much the expense is going to be each year. And GAAP and IFRS are happy with us using that. And it's clearer to compare. Accelerated methods are often chosen for tax purposes. The reason for that is because they're able to get that tax benefit. They lower their income earlier on after making a big purchase. And you can use one method for taxes and another method for financial reporting. Tech, manufacturing, and energy companies line up well with accelerated methods due to their products losing value quickly over time. So if they were going to choose to use an accelerated method, a lot of times it would be a company like one of those. Now let's finish up by talking about partial year depreciation. So partial year depreciation is when an asset is purchased or disposed of during the middle of a year rather than the first day of the year. So a lot of times in these examples, they're like, we bought an asset on January 1st. Like, wow, how convenient. But that's not always the case. And there's half year convention where they could say, we'll just make it even half of the year, even though it wasn't bought exactly June 30th. They'll go ahead and do it that way sometimes. So we're going to finish up with this last chart here in this video. So for straight line, it's not too difficult. It's just if we use the same example, they say, okay, they want to depreciate it by $18,000 a year. But if they're using the half year convention, they only want to do partial depreciation. The first year, they're going to take half of the $18,000 and they're going to depreciate $9,000. But that then brings us into the 7th year to have $9,000 depreciated as well. So we have half in year 1 and then half in year 7 to total $108,000. It gets a lot more complicated with double declining because here we're going to take that 33% that we just saw and they're going to take half of the year times the book value, and that will give us the double declining. So then we'll have a new book value. So we have the 120 minus the accumulated depreciation from year 1 times 33%, and we would just keep doing it that way. But it primarily is going to be odd whenever we have the first year because it's only half of the year. And then on the 7th year, we're going to just get it to where it totals 108,000 and leaves us with a salvage value of 12,000. So that is the 4 methods that we're covering in this chapter for depreciation. And then in the next chapter, we're going to talk about disposing of a property, plant, or equipment asset.